Hello, thank you for staying with SABC News. This is Your Money on Market Sense. This feature focuses on personal finance. This week we explore investing, and since July is Savings Month, we also have invited an investment expert to teach us about investing so that our money grows. But in the meantime, financial advisors have called on consumers to look into various investment vehicles that offer higher returns and that can beat inflation. And as specialist reporter Naledi Matlapeng reports, experts say one does not need to be a sophisticated investor to have an investment portfolio. Take a look.
South Africa's household savings rate is currently 18% of gross domestic product. And with July being Savings Month, consumers are once again urged to invest more and spend less.
For those people that are employed, we do seem also to be a nation of consumers. We like to consume things. We like to have cars and houses, and that's probably our failing at the moment.
It is suggested that you should have a clear plan of what you want to achieve when you are investing. If you want to save for emergencies, then you should consider putting your money where it will be easily accessible, like a bank account. And if you want to invest for the long term, it should be invested in portfolios linked to the stock market.
It's wise to have a 30-day call account, to have money that's going to be not in a volatile space, not invested in the market. Once you've ticked that box, you then move along into longer term investing, and definitely if you're not in the JSE, if you're not in the market, you're missing potential massive growth.
There's a variety of investment options to choose from, ranging from exchange-traded funds, Cetrix Top 40 and unit trusts. Both ETFs and unit trusts are collective investment schemes. With ETFs, you will pay brokerage fees as you are likely to utilize the services of a stockbroker, whereas unit trusts are actively managed by a fund manager. ETFs are less volatile than some unit trusts. ETFs are likely to have low costs, whereas unit trust costs might be slightly higher. ETFs are priced immediately, and unit trusts are priced on a daily basis.
The difference with ETFs is you actually own the underlying shares or securities on that exchange. So you actually buy and sell the shares as well through a broker.
If you want good returns, you should diversify your investment and have some exposure to the equity market. These are aggressive investments with possible good growth, but you must be willing to invest for the long term and bear in mind that equities are volatile in nature.
If you put money just purely into an interest-bearing account, you have to consider the effects of inflation. That's one of the enemies of saving and us just living generally. It means the value of your money declines over time. So if we look at our inflation rate at the moment around 4.5%, that means typically that your money today is worth 4.5% less, or it can buy 4.5% less than it could last year.
Investing is a long-term decision, and the younger you start saving, the better, because you will benefit from compound interest, and always ensure that you invest in growth assets that can beat inflation and are linked to the stock market, instead of just putting your money in a bank account. Tax-free savings gives you an opportunity to save without having to incur capital gains tax, but you are only allowed to invest up to 33,000 rand per year and a maximum of 500,000 rand in your lifetime.
I'm a big fan of tax-free savings. They have their place in a portfolio. So once a client has got that emergency savings and they've got that liquid unit trust or discretionary money ticked, then they look at tax-free savings. Tax-free savings, of course, they benefit from no capital gains, dividend interest tax, etc. The downside or upside is you are limited to 33,000 per annum that you can put in there, and also capped at 500,000 per lifetime. They go very nicely hand in hand with retirement annuity investments or longer term investments.
I'd like to hear your views on this topic. My email address is mulifint@sabc.co.za. My Twitter handle is @mulifinaledi.
We really do encourage you to make contact with Naledi Matlapeng, our specialist reporter. She focuses on personal finance. Moving right along, our guest today is Ngoni Kwatitso. He is a chief investment officer at Weaver. Ngoni is going to give us a better understanding of savings tools available, in particular exchange-traded funds and unit trusts, and how you can make your money grow. Ngoni, thank you very much for your time.
Thank you, Diabo.
So we speak a lot about July being Savings Month, and we tell people how they should be saving, but are we encouraging them a lot to use investments and how to invest their money? And should they be investing all of their savings in vehicles such as ETFs and unit trusts?
Well, investing and savings are two different concepts. They might look the same, but there are subtle differences. The main difference being savings are usually for short-term emergencies. I think you heard Naledi talking.
Yeah.
And then investments is usually for a longer term, and longer term is in time. We can talk about 3 years.
Yeah.
Is the long time horizon.
Why do you think that investments are not so popular? People seem to be not very keen to putting their money for the long term. Is it because they do not see the benefit at that time? And how do we send the message to people to keep their money in for longer so that they can see a much more useful return?
I think that the biggest problem is probably lack of knowledge in terms of the differences between the two concepts, investments and savings. I think that most people, the ordinary person, would think that they are actually saving when they keep their money in the money market account. It is actually important to point out that money market accounts, yes, you can save 30 days, you can even up to have one year, but over a longer period of time, the value of that money gets eroded by inflation.
So let's talk about the difference between exchange-traded funds, which are ETFs, and unit trusts. Naledi did mention it in her insert there, but I want to turn your attention to the video wall, and we'll see there the characteristics. I want us to talk about the characteristics of exchange-traded funds so that people at home know how to separate the two. Take us through this. We say that it's a basket of securities that trade on an exchange, just like a stock. It's not necessarily a stock, but it trades like it. Tell me a bit more about this.
Well, a basket is actually a good terminology. What you have different types of ETFs, and most of these actually track certain indices. The most common one is, let's talk about the top 40 of this is the largest the largest shares by capitalization on the JSE. And what an ETF is, you actually buying a component of all those stocks in one unit.
In one unit.
Yes.
Okay, and it also says that it can contain all types of investments. So it can be mining, it can be banking, it can be retail, and so forth.
Yes. Over the past few years, we've seen a proliferation of lots of ETFs, which makes it actually much more easier for investors. You have ETFs in almost every asset class. You can have them even in cash, bonds, certain subsectors of the exchange, financials, resources, and etc. You can also have ETFs for offshore companies as well. The MSCI, for instance, there are ETFs which also represent major world stocks which can be contained also in a basket.
Let me ask my colleagues to bring up the unit trust one so that we can look at least two differences that we see there. We say that the fund manager makes the investment decision on your behalf, but you cannot access, that person, the same fund manager, cannot access your cash. This is one surety that as an investor I want, right?
Yes, sure. I think it is important to know that there are different players in this game. Of course, the main one is your manager, which you actually want to be continuously relating to in order to see how much of your investments have gone. But you must know that behind that there are regulations where your manager themselves, the asset manager, does not actually hold any cash. This cash is, these assets are kept elsewhere by a custodian, which actually gives you the
comfort.
The comfort, yeah.
Yeah.
I just want to emphasize on you can't access your cash. It might sound...
No, what I mean is that the fund manager is the one
yes.
that cannot access your
No, he
your
cannot.
cash.
He
Yes.
cannot. He can definitely not.
Okay.
Yes.
And let's talk about it being easy to trade unit trusts very quickly through that one.
Well, unit trusts are also easily traded. The only difference is that the price of a unit trust is only determined at the end of the day, as opposed to the previous instruments, the ETFs, where it is actually traded and you can see movements on a minute-by-minute basis.
Lastly, how do we make these investment tools accessible to the larger public? We are telling them that they need to have a little bit of money saved somewhere for emergencies and that they can save others. If you could just quickly run through the importance of that.
Okay, if we start with exchange-traded funds, there are already outlets there. You have your the Satrix, where you can go and buy from. You've got Easy Equities, where you can also go. Then you've got Etfs, which is a company which was set specifically to deal with exchange-traded funds. And I think the most important thing to add is that investors might need a little bit of assistance because some of the products can be too complicated, but you need to have a broker, and some brokers charge money, others don't. Like Etfs say they don't charge you any money, so you need to bear that in mind.
Ngoni, thank you for your time. I'm afraid that that's all we have time for this afternoon, but I really appreciate your insight on your money on Market Sense. Well, coming up after the break, Books on Point with Nastasia Arendse. Today, Nastasia chats with Karen Dolly, the author of Enforcers, Inside Cape Town's Deadly Nightclub Battles, coming up after the break.